Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Currency Analyst at MUFG. It's Friday, 14th January 2022, and joining Lee to pose some questions on the financial market themes for the week ahead is Simon Mays, Director of MUFG's Global Customer Marketing Group for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Good afternoon, Lee. The festive break already seems a long way behind us. So what's been the main focus in the FX market at the start of the new year?
Well, hi, Simon. Obviously at the start of this year, I think the big surprise in the FX market has been the sell-off that we've seen in the US dollar. Obviously at the start of this year, I think consensus is very bullish on the dollar, looking for a further strength. But obviously that hasn't happened so far, which is surprising on a number of counts. Obviously, we have seen US yields continue to hit fresh highs at the start of this year, both in kind of nominal yields and also real yields. So normally you would expect to see these kind of higher US yields feed through and encourage a stronger dollar. But so far, we haven't really seen that follow through in the FX market. And I think that lack of follow through is fueling speculation, at least in the near term, that the dollar could be potentially kind of peaking out, given that it's kind of already trading at very overvalued levels, particularly against some of the kind of low yielding currencies such as the yen and the euro. And if we look back as well, historically, over kind of Fed tightening cycles, it's usually in the period running up to the Fed's first hike that the dollar tends to strengthen in anticipation of the rate hikes to come. And then once the Fed starts raising rates, that's when you start to lose some upward momentum in the dollar. So recent price action potentially is kind of somewhat kind of consistent with the historical precedent as well. And from that perspective as well, I think market participants may also be drawing some comfort from the fact that the US rate market has already moved a long way now, pricing in up to 4 rate hikes from the Fed this year. So it's going to be hard for the Fed to kind of exceed those expectations. So that may be giving some further encouragement to market participants that the scope for short-term US yields to go higher in the short term is going to be more difficult going forward. And then I think we also have to look as well at position adjustment as a potential kind of trigger for this period of dollar weakness at the start of the year. So if we look at, say, the latest IMM positioning report, at the start of this year, we saw dollar long positions amongst asset managers, institutional investors, and the leverage funds as well. That total dollar long position, that reached its highest level since early in 2019. So we did see the market coming into this year very heavily positioned long dollars. And obviously the fact that we haven't seen the spot price action backing up those positions, I think has likely meant that we have seen some kind of paring back of those long positions over the past week, and that has likely kind of reinforced the weakness that we've seen in the dollar. And then finally, as well, I think we also have to take into consideration the kind of overall kind of global macro backdrop. So I think what has been important over the last couple of weeks, certainly over the holiday period, has been the fact that the data that we've seen on the ground with regards to the kind of spread of this new Omicron variant has certainly backed up optimism amongst investors that it looks like the hit to global growth at the start of this year from the Omicron wave is going to be more modest than we've seen in previous COVID waves. And that's obviously a positive. It is helping to kind of ease investor fears over the outlook for global growth for the year ahead. And I think that is encouraging as well investors to go back into kind of risk assets, and that kind of process is putting some downward pressure on the dollar as well. Obviously, that's a very important kind of positive development, at least in the short term, for emerging markets, because they obviously had a very bad year last year. They were hit by the stronger dollar and higher US yields. So the fact that the dollar has, at least in the near term, is correcting lower is also providing some much needed relief for emerging markets. Having said that, though, we're still not really convinced at this stage that this is the start of a more kind of sustained kind of weakening trend for the dollar. We're still wary of the risk going forward that we could have another US rate shock this year. We still think there's two potential ways that could develop. There's the risk that the US rate market could move to price in a higher terminal rate, or alternatively, the Fed could decide to shrink their balance sheet sooner and faster than the market's currently expecting. And both of those potential triggers could lead to some further upward pressure on US yields and still lead to some further upside for the dollar. So that's still our base case scenario for the next 3 to 6 months.
Thanks, Lee. And we've already had plenty of tier one US data so far this year, and some Fed rhetoric as well. So what do you think the key events will be to watch out for in the week ahead?
Yeah, we'll be watching closely the upcoming BOJ policy meeting next week. Normally, if we look at kind of the performance of dollar yen around BOJ meetings, does tend to have only a very limited impact on dollar yen. So normally speaking, it shouldn't be much of a market mover for the yen in the week ahead. But this time around, there potentially could be more market moving. Obviously, we had the report released overnight from Reuters, which has captured some market attention over in Japan. And that report was suggesting that the BOJ is starting to think about the possibility of kind of signaling to markets that they may need to raise rates further down the line. Like our own view is that we still think it's way too premature to expect the BOJ to raise rates anytime soon. It's certainly not going to happen at all this year, or possibly even next year. So I don't think immediately we're going to see any policy change from the BOJ. But given that the Japanese rate market is very kind of confident that rates are going to remain very low for the foreseeable future, even if there was any kind of slight shift in a more hawkish direction from policy signaling from the BOJ, that could feed through to kind of a further strength in the yen. Certainly over the past week, we have seen the yen kind of outperforming with dollar yen dropping back below the 115 level. So in the short term, at least, perhaps the risks are still more tilted to the downside for dollar yen. But we think as long as there's no hawkish surprises from the BOJ next week, then I think dollar yen, in our view, is still more likely than not to still trend higher for now. Obviously, if dollar yen continues to fail to kind of break above this kind of longer term trend line resistance area around 117, the longer that it fails to break above there, the more confident we would be that we've probably seen the high for this cycle in dollar yen, and this could be more of a kind of sustainable kind of turning point for dollar yen. Elsewhere, other things that we'll be watching out for in the week ahead will be the kind of latest data coming from the UK economy. We get the release of the latest CPI report and also labour market data from the UK, and we think that data should reinforce expectations that the Bank of England is going to continue to tighten policy going forward. We're now expecting the Bank of England to raise rates again by 25 basis points at their next meeting at the start of February. We have been encouraged by the spread of the COVID pandemic in the UK. Looks like it's going to be certainly much quicker than people had anticipated. It looks like already that while COVID cases have risen very sharply, it looks like they have already kind of peaked out, and that if we see a similar pattern to what was repeated in South Africa, where cases have since fallen very sharply, I think we could be kind of safe to assume that we're kind of getting through the worst stage now of this current wave in the UK, and that should allow the economy to then start bouncing back towards the end of this month into later Q1, and that's, I think, a reassuring thing for the Bank of England. They obviously were concerned about the uncertainty over COVID back at the December meeting, but still hiked rates. But obviously, since then, it looks like the kind of worst case scenario of this wave has diminished, and that it's looking like the hit to growth will be more limited. So, we think the UK economy looks like it should be bouncing back through the rest of this year, and the Bank of England, we think, will need to tighten policy further. They've already signalled that they expect inflation to continue rising up towards a peak of around 6% going into the spring, and the policy rate is still incredibly low right now. So there's still ample room there for them to deliver further hikes going forward. And I think that should, all else things being equal, should feed through to a stronger pound. We still think that is most likely against the euro. We still see some further downside for euro sterling going forward. One kind of thing that people have been watching as well this week in the UK has been the pickup we've seen in political risk, with speculation intensifying over the future of Prime Minister Boris Johnson. On that side of things, all we'll say at this point in time is that yes, certainly there is an increased risk that he could be replaced as Prime Minister. We don't think that's going to be immediately, but obviously if the Conservatives perform particularly badly at the local elections in May, then pressure may continue to build to replace Boris Johnson as Prime Minister. In terms of the implications, though, for the pound and the UK economy, we'd still expect that in the near term to be fairly limited. We wouldn't expect any major changes to government policies over the shorter term. So for the impact, therefore, should be fairly limited on the pound. So even if we do see more of a pickup in political uncertainty in the UK, we don't see that as being much of a negative factor for the pound going forward.
Thanks very much, Lee, for your thoughts, and have a great weekend ahead.
Thank you, Simon.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research Team.